In the time it takes you to blink your eye, literally thousands of trades can be executed all over the world. Now, this isn't people sitting at desks. This is the work of invisible machines, bots, locked in this constant high-speed hunt for profit. Today, we're going to pull back the curtain on this hidden world of automated arbitrage.
So let's just start with a question that sounds, well, almost too good to be true, right? Is it actually possible to make a profit with absolutely zero risk? In theory, the answer is yes, and that's the core promise of this whole concept we call arbitrage.
In its purest, most perfect form, arbitrage is exactly that. It's about finding a price mismatch for the exact same thing in two different places. Imagine you could buy something low over here and sell it high over there at the exact same moment. You've just locked in a guaranteed, risk-free profit.
Okay, so let's dive a little deeper into that. What does it really take to pull one of these trades off? Well, it all boils down to three essential ingredients.
First, of course, you need that price difference. Second, the trades have to happen at the exact same time. We're talking simultaneous. If there's any delay, the price could shift, and poof, your risk-free profit is gone. And third, and this is really the key in the modern world, you have to be fast, unbelievably fast, because these price gaps might only exist for a few milliseconds.
And that insane need for speed has totally transformed this simple idea into what is now a super complex, high-tech battlefield. Which brings us to what this all looks like today.
See, back in the day, arbitrage might have been something like buying spices in one port and shipping them to another where they're worth more. It was slow, it was human-driven, and the profits could be pretty big, but you didn't find those chances every day. Today, it's a completely different game. It's a world of digital assets, ruled by bots that operate in milliseconds, constantly hunting for thousands of tiny, razor-thin opportunities every single day.
A perfect example of this is something called latency arbitrage. Honestly, you should think of it like a photo-finish race for profits. A bot sees a price update on one exchange a fraction of a second before another one does, and it jumps on that tiny delay in information. The fastest bot to react wins the prize. Simple as that.
But here's the other side of the story. From the broker's point of view, this isn't some clever trading strategy. They actually have a name for it: toxic flow. Why? Because from their perspective, these bots only ever trade when they have a guaranteed win, which means they are systematically pulling money away from the broker who is, for just a split second, showing an old, outdated price. And if you think that's wild, the world of crypto and decentralized finance has taken this to a whole new level with something called flash loans. Now get this, a bot can borrow millions of dollars with zero collateral, execute an arbitrage trade, and pay the loan back, all in the same instant, all inside one single blockchain transaction. If the trade doesn't make a profit for any reason, the whole thing just reverses like it never even happened. We're talking zero upfront capital and literally zero risk.
So how in the world do these invisible machines actually work? What's going on inside the code? Well, let's pop the hood and take a look at the basic anatomy of one of these arbitrage bots.
The huge advantage here is just relentless, tireless automation. A bot can scan thousands of different assets across dozens of exchanges 24/7. It never sleeps, it never gets tired, and it reacts in microseconds to these tiny opportunities that a human trader wouldn't even know existed.
The way they're built is actually pretty logical. You've got the data layer, which you can think of as the eyes and ears, just drinking from a fire hose of market data. Then there's the signal layer, which is the brain. It's constantly analyzing that data, asking, is there an opportunity here? Now? How about now? Once it spots one, the execution layer kicks in, the hands, placing the buy and sell orders. And watching over the whole thing is the risk layer, a critical supervisor that makes sure the bot stays within safe limits and never goes rogue.
But here's the thing. You can't just download some code from the internet and press go. Building a bot that's actually profitable and, more importantly, safe is a serious engineering challenge. It involves a really rigorous, multi-stage process.
The whole development lifecycle is incredibly disciplined. It all starts with research and picking a strategy. Then you build a prototype and you test it like crazy. Only after it passes those tests do you build the real production-level code, hardening it for security. And even then, you don't just unleash it. You start small, with what's called a canary deployment, using just a little bit of money, and you monitor it constantly to make sure everything is working exactly as planned. Now, the most critical step in that whole process is backtesting.
The best way to think of it is like a flight simulator for your trading strategy. You run your bot against months or even years of historical market data to see how it would have performed in the real world. And you have to account for everything: trading fees, network delays, and something called slippage, which is that tiny price difference that can happen between when you think you're trading and when your order actually gets filled. You just don't risk real money until that strategy has flown thousands of simulated hours successfully.
So this brings us to the central conflict of this whole world, because brokers, as you can imagine, don't just sit back and watch their money get siphoned off. What it creates is this ongoing technological arms race, a constant digital cat-and-mouse game.
On one side, you have the traders using all these clever techniques to mask what their bots are doing. For instance, they might intentionally make random losing trades. They call it noise trading, just to throw the broker off the scent and make their winning strategy harder to spot. And on the other side, brokers are deploying incredibly sophisticated defenses, like machine learning models that are trained to identify the statistical footprint of these so-called toxic trading patterns.
So where does this high-stakes game of cat and mouse eventually lead? Well, as you might guess, the next frontier in this arms race is, of course, artificial intelligence.
Both sides are now heavily invested in AI and machine learning. Traders are using it to find ever more subtle, complex patterns in the market that no human could ever see. And at the same time, brokers are using it to build even smarter, more adaptive detection systems. The machines are literally learning how to outsmart each other in real time.
But all of this intense competition leads to a really fascinating outcome. When a profitable inefficiency is found and exploited by enough bots, that opportunity gets arbitraged out. The price gap closes, and the profit just disappears. In a strange way, arbitrage becomes a victim of its own success. The very act of exploiting an inefficiency is what makes the market more efficient. And this brings us right back to where we started. As these AI-powered machines get faster and smarter and better, they are making our financial markets more and more efficient. Which leaves us with one final, pretty provocative question. Are we building a future where markets become so perfect, so efficient, that all of these tiny profit opportunities get arbitraged out forever?